All right, welcome to the second of the core knowledge videos, as I'm calling them. And in this one, we're going to cover generally accepted accounting principles, which you'll see are grouped. There's 10 of them overall, and there's 3 basic groups here. The first group that we'll look at is accounting principles. I know we call the whole thing principles, but there's really 3 subcategories. So accounting principles, 4 of those. We have 4 assumptions and 2 constraints. All right, so first let's go over the principles. And again, these are just a list. There's no order of importance here. It's just a straightforward list. All right, so first up is the measurement principle, which is covered in the first series of videos for Chapter 1. And remember, this is sometimes called the cost principle. So either a measurement or cost principle. This is the one that's telling us we have to delineate transactions in historical US dollars. Now again, that kind of overlaps with the monetary unit assumption, but it's kind of inevitable. There's really no other way to refer to it as. So they're kind of tied to each other, is what the reality is there. Right, so that's the one telling us we got to use historical versus current costs because it's more verifiable. That was the bottom line there. Now, full disclosure, it's just like it sounds. We have to detail everything that we consider to be necessary information for external users to the business. In other words, what you'll observe is that a lot of time it's footnotes that we're talking about. We talk about full disclosure. Obviously, everything that's in the body of the financial statements would be relevant information. But what if you have some things that are maybe not pertinent in that context, but are nevertheless should be disclosed? So that's where the footnotes come into play. So again, this is going to include details backing financial statements and possible future events of significance, something that might have a large impact on the business. So anything that fits into those categories, and usually like footnotes for these future significant events would fall under the heading of contingent liabilities, meaning you have something out there that is going to maybe hit the company, but it's not, we can't book it yet, right? So we can't integrate it in the financial statements because we maybe lack certainty as to how certain it is that we're going to maybe have to pay on this amount sometime in the future. So we'll just say, hey, guess what? We might be getting sued for a lot of money. We don't know yet what the amount of the lawsuit is or how certain it is, but it's worth saying just FYI. So that's where the footnotes come into play with events like that. So something that has yet to happen could impact the business later. So that's important. So if you're looking at investing in companies, read the footnotes. Sometimes there are some bombs back there. Then they're never going to put it in the front of the report because they're going to leave it up to you to do due diligence as a potential investor and look that stuff up. All right, 3 and 4 were both also investigated in the first stretch of videos here. So revenue and expense recognition. So again, these are the ones that are telling us like when do we recognize revenue, when do we recognize expenses, and of course remember the short like answers are we recognize revenues when earned and expenses when incurred. Again, how do you earn revenue? By providing services or selling goods to a customer. As soon as that happens, we want to recognize it. We don't care when cash is received. Expenses are incurred when what happens? When we use goods or services, regardless of when cash was received. So those 2 principles are the ones that are guiding us away from thinking about the way like income, net income of the business, or net loss in terms of cash. Right, because it's too primitive of an idea. And then in another video, if you haven't yet seen it, I'll cover like why we want to recognize revenues and expenses in this manner versus doing cash basis, because there's some erratic like patterns you'll observe with cash basis. So there's a bit of a smoothing we're hoping with respect to like how net income looks versus cash basis by virtue of these 2 principles here. So those are our principles. We have 4 assumptions. We already talked about monetary unit, and that's just sort of the one that dovetails with measurement. In other words, how are we measuring things? Historical cost and in US dollars. So that's just saying our local monetary unit is US dollars, so that's what we're going to use as an assumption for all of our transactions. Now, the first one in order here, going concern, all that says is, again, we're assuming the business is going to be going on forever. Why do we do that? Because it's simpler if we just assume that. Otherwise, it might get a little bit strange to try to say, well, we only think we're going to be around another 3 years or whatever. How do you account for a business that you think is going to go under at any moment? Also, from an investor standpoint, that sounds like it might cause a bit of a panic necessarily among investors if you start to reflect the possibility that we don't know how long we're going to be around for. So we just say, do away with that. We assume until otherwise, we have knowledge to the contrary, we're going on forever here. Right, time period principle, This one, which is I think sometimes referred to in some of the textbooks as the periodicity assumption, I hate that, by the way. I think it's just like way over the top. All it means is that we can take whatever we're reporting and we can splice it into months, quarters, and years for reporting purposes. That's all. Just means we can chop up the information into these increments at will. So that's just one of the things we assume when we're reporting for a company. And the business entity concept is the very first thing that I tackle in the very first video. So that's another one of those, if you've even just seen the first stretch, it's like, oh, that rings a bell. Yeah. In other words, we're saying businesses are separate from owners, employees, and other businesses. We're just saying this is the parameters that we want to account for, nothing more, nothing less. And then lastly, we have a couple of constraints on our hands. In other words, these are the things that are telling us, like, is there some point at which, like, regardless of what our principles and our assumptions are, is there something that we get to a point where we say, well, maybe we don't have to worry about that thing. And this is the two are materiality and benefits exceeding cost, also known as cost benefits. So first we'll tackle materiality. So what we're saying here is we only need to report information that would impact external user decisions. So if it's not going to impact their decisions, right? In other words, we believe if we do, like, I guess the best way to tackle this one in terms of like the philosophy of it is, if we took this one element reporting-wise and we subtracted it from the company's record keeping, right? We subtracted it from their financial statements. Would users make a substantially different decision on the economic wellness of that company? Is it good investment, bad investment, or whatever the case may be? If you can take that out and people would be like, it doesn't make any difference, it means it's probably immaterial, therefore you don't need to report it. So that's all materiality is telling us. Like, in other words, it's something that would be immaterial. Now, you'll see throughout the handouts, throughout the videos, dealing with various subjects, materiality takes on a different, it takes on a different facet depending upon what we're talking about. Like, in the context, like if you look, just to give you sort of a preview if you haven't seen these already, like, for example, like one of the first times I'll talk about materiality in something is when we're accounting for supplies, right? We don't care too much about supplies being perfectly accurate. So in other words, if somebody estimates what supplies remaining are in backs and a supply is used, we're okay with that because the difference is probably immaterial, right? An exact accounting of supplies might give us a number plus or minus like $100 or $200. And if we're talking about a company where we're talking, hundreds of thousands or millions of dollars, $100 is not going to be a material difference. Nobody's going to make a different decision based upon that. On the other hand, when I talk about materiality in the context of, let's say, you're doing a bank reconciliation and you're off by like $500 and the account is $10 million, I say there, would you look for the $500 discrepancy? And the answer is yes, because somebody could be stealing from me. So even though the $500 is immaterial with respect to the amount in the account, how grandiose it is material with respect to possibly somebody is found a way, past your internal controls. They find a way to, sidestep them. So you want to look to verify if you're just dealing with an honest error or is there something going on there. So again, materiality takes on a different, it's a different animal depending upon the context of what you're dealing with. Now, benefits exceeding cost, which I really prefer as cost benefit, which is sometimes we call it the cost benefit analysis. That's another subset there. In other words, we say, okay, if this something we want to implement in the accounting system, what's going to be the benefit of it? How much is it going to cost us? What's the benefit to us from an information standpoint? What's the information we're going to gain here? Like one of the first times that I introduced this, you'll see in a video, is when I talk about like why we depreciate assets using, which is more or less an arbitrary set of methods that really aren't, in other words, we don't care about like real world depreciation. What did you pay for something? What's its cost minus what's its current value? We could do that, but again, this constraint of cost benefit. So if we do an analysis of how much it would cost to implement that system, it would be very costly. What would be the benefit of it? Would external users get additional information out of such a system? And the answer is no. No, they wouldn't. It would be costly, but it wouldn't really change people's minds. So it actually, in a strange way, it intersects back with materiality to some extent as well. In other words, it might be an immaterial difference between these arbitrary methods versus the real world methods. And of course, we all get together and say, well, they're costly to do real world depreciation, meaning, again, what you pay for it minus what current cost is. So we have that being costly. And what's the benefit? Well, there's not much benefit. In other words, sticking to the arbitrary systems we have now, we get comparability. Therefore, it's still beneficial to external users. So that's one of those things where we would say, no, we're not going to do that because of this constraint. So that's how the constraints fit in. They're just sort of the things that are tying you to reality, meaning we might want to do quote-unquote perfect accounting, but that's just not possible because we might be dealing with immaterial things or things where it's so costly to do the perfect thing that it just isn't worth it. And we're not going to ask companies to incur costs unnecessarily to get us to perfection when being less than perfect still gives users the same information value. So that's what we're looking at there. All right, then that concludes the second in the series of the core knowledge videos. See you in the next one.